Products for less than 3 years tenure. Why do we need to bring solutions? Early career individuals may lack credit history or savings for traditional mortgages. So the solution is that rent to own schemes or credit building loans help them to qualify for future mortgages while reducing lender risk. While coming to greater than 20 years tenure, we need to make them aware. Why? Because older borrowers might need liquidity without selling assets. So we need to introduce equity release mortgages, which means that we can access the home equity for retirement funds, and the reverse mortgages where no payments, monthly payments is required, loan repaid upon property sale is required. Okay. Next is the adjust. We need to adjust certain risk policies for less than 3 years of tenure, and for 3 to 5 years of tenure, we need to make strict terms where we need to confine the long into the stricter ones or the shorter ones where the high down payments are required to mitigate risk from unstable income or job changes. Most of these people would be like transitional people, so we need to make sure regarding their job changing aspects as well. When you're coming to 5 to 20 years, we can see that we need to give some concessions or incentivize rates like discounts to attract low risk borrowers and boost the market share as well. So based on this, there are certain strategic goals for balancing approvals with safeguards for high risk tenants, which is mainly for the risk management. Coming, as we know that even market expansion is more required, as we know that we need to capture the underserved group such as the young professionals or retirees. Customer retention is much required, where we need to build loyalty between the tailored products such as rent to own leading to traditional mortgages. This approach will help the lenders to know the cycles where they would optimize the risk reward outcomes. Coming to loan intent analysis, we can see that the analysis involves a different type of loan types based on their loan to income ratio, which measures the amount borrowed relative to borrower's income. As we see, the higher ratio, which indicates a greater financial commitment, while the lower ratio indicates that the more conservative borrowings. So as we see that the medical loans are accounting to 0.151, which is the highest ratio. Now, why is this so? Medical emergencies often require immediate high cost financing, which implies that the borrowers may face repayment strain due to high debt relative to income. Most of the category of the people from A to G are involved in this, which means that it becomes a necessary for us to be used. And we know that lenders should assess affordability carefully or offer a flexible repayment. Coming to education loan, which comes to 0.148, which is towards the second. The education loan is something which is a long-term process, and the borrowers might take it for studying more degrees abroad or within the country. So this implies a high confidence in the future earnings, which means that the students take a loan, and when they go to another place, they might require to do a part-time job where they get a pretty amount and they can spend it. They can use it for compensating for their loans, which are need to be repaid as a obligation towards the lenders. Coming that also, risk varies by risk field of study. Income driven repayment plans can mitigate defaults as well. Coming to venture and debt consolidation loans, it comes to 0.14, which means that it's used for a business growth, indicating calculated risk taking process. Also, we can see that debt consolidation loans also would combine multiple debts into one, often improving repayment terms. This implies that the venture loans depends on business success. Lenders should evaluate business plans accordingly. Debt consolidation borrowers may have better cash flow post refinancing. Next one coming is the personal loan. For personal and home improvement, we can see that there is a tie between those, which are the lowest ratios. These are mostly used as a smaller discretionary loans for certain purposes like vacations or renovations, which implies that the lower risk due to manageable amounts and shorter terms. Lenders can streamline approvals for creditworthy borrowers as well. Coming to the time series analysis, we can see that there is an analysis which examines how the default rates correlates with the length of borrower's credit history. It talks about the credit history of certain borrowers based on the lenders as well, which reveals the key risk patterns that the lenders should consider when evaluating loan applications. While sanctioning certain loans, we should also need to know the history of how that person is, or how those category of people are, so that we can give it based on should it be greater than the default amount or should it be lesser than the default amount. So as key findings, we have found out that there are short credit histories for less than 5 years, which means that there is a default rate of 22 to 23%. Why so? Because the limited credit data makes risk assessment difficult. Often younger borrowers or those new to credit with unproven repayment behavior are there, which implies that stricter undertaking should be done for this group as well. Now coming to a declining risk, as we can see, there's a decline of risk in 5 to 18 years, which means there is a that is for the immediate credit histories. As we see, there's a drop steadily, which means that 19% of them are at mid-range. Why is it so? This is because established credit profiles demonstrate consistent repayment habits. Most of these people might be a reliable people, or we can say stability in their financial areas, where they try to give it within an earlier times as well. Implication which offers that there is a competitive rates and terms to these low risk segments. Most of these people might have competitive rates which need to be given at a certain amount, so there is a delay in time as well from their time, but they try to settle it within certain stipulated time as well. Coming to unexpected side, where the long credit histories are there, where 19 plus years is given there, so we can see that for them there is a high rise of borrowers in this kind of areas, where 42.86% are at 29 years. Older borrowings may face retirement income drops, medical expenses, or any fixed income reliance. And coming that the potential credit fatigue or over leveraging after decades of borrowing. So there can be even a spike due to, we can see that there can be a credit fatigue where they tried to settle it, but then maybe into some any other cost they couldn't give it as a whole amount, or we can say maybe debt trap can be one of the causes. This can give them overheads where they have to pay more within that period where they try to pay more, which implies that they're reassessing risk models for seniors. That is, for example, we can say considering equity based loans or income verification. Coming to this, we can see that this is the DANX function that I have used for calculating the loan amount and the loan interest, which is having a distinguish between the loan rate. So we can see that over here key observations are loan amounts and risk are having a relationship. Larger the loans are typical to offer lower risk borrowers. So we can see that lower risk borrowers such as A, B, C are there, where A is having first, we can see with lesser than the default, as we see that the default lies between 8 to 10, which comes around maybe 9.5 something, and it just comes for A it comes around 8.2 or 8.3, which is the amount which is lesser than the default value which need to be paid. But when you come to the B section, we can see that those kind of categories are pretty lesser, and a loan amount comes greater than default. This is because that most of these customers might be reliable customers. They might be of a class where they have prospective businesses, engineers, doctors, which middle class or a higher class people try to pay here. A are the categories, maybe they are of long-term business people, where they try to pay after certain time. That loan rate comes to a very lesser value as well than the default rate. Coming to C, as we increase the categories, we can see that there is a huge growth of the default rate as we reach D2 F and G, we can see that there is a huge growth of the default rate, which means that there's a loan amount is pretty smaller than the default rate, which means that there are a lot of financial obligations within these areas. Especially when you check at F and G, we can see it's increasingly high. Most of these people might be underemployed or unemployed, which might be getting, or there are employed people which might be getting lesser than the salary that they have got. So it is not easy for them to, for their income to satisfy the basic needs, so they try to take more loan, which comes to a loan which comes to a debt trap, or we can say they are reluctant, or they might not pay at a at that same stage, which might lead to more defaults and might lead to more financial obligation at a later stage. Coming to loan interest rate, we can see there's a interest rate comes to all least itself, because for the higher areas we can just see from this, as we can see that the lower interest rates are given to the lower risk borrowers, and these borrowers pose less risk, so lenders compete for their business with better rates. Higher interest rates are charged to high risk borrowers to compensate for the increased chance of defaults. So when you're saying that these type of people, we can say a relationship as well. Increased loan means means that default rate is less, which means that bigger loans usually mean lower risk. Interest rates tries to increase, and the default rate increases, means higher rate correlates with riskier borrowers who default more often. So for this type of category, we need to say that more the number of amount of loan they take, and they don't repay at that time, the defaults become more, which will be more obligation for them to pay at a later stage. When we are coming at ABC, we can see that they try to pay at within a shorter period, which means that they try to take more loans and they become a reliable customers as well. That's what. Next coming, this is about the distribution of employees. We can see that most of them come under the repayment are done, which are the good employees. They try to pay within that area, but there are certain type of employees who don't pay within that time. Huge number of people who don't pay are within the category of zero employee length, which means that they are yet to pay at a certain time, but as the time decreases, they start paying if they are employed, and all those will come to negligence, where their salary status will become high and the loan status will become low as well. So as the salary goes high, the loan becomes low, and as the loan becomes high, the most of the people would be underprivileged, where their salary won't meet up with the loans. Coming to here, we can see that home improvements are there, and we can see the medical and the educational. Most of this we can see highlightingly educational and medical is there, where where these two are coming as a least income people. Most of the categories go for this. So the loan intent for them, the average amount of loan that they take is 9k to 9k, which means that most of these people as it's a necessity for them to go without medical and educational is hard for any person on any group, so they try to go with that, which means that they need to meet as per their requirements as well. That's why we can see that medical and education is having the highest risk than the other sectors. So this is the credit history based on the certain age groups, based on the default rates. Okay. Now this is the interest rate. We can see that the adjusted default rates goes proportionally within the interest rate itself. So as we see that there's a decline first. Decline in the adjusted default rate gives the interest rate decline. Then there is a huge increase, which means that the interest rate also increases with the adjusted default rate. So it all go in a proportional positive manner. This is the loan amount age wise, and which would be discussed in the implementation part. We can see that 65 and 66 comes in the highest risk here. This tells us about higher risk score, means basically the people who try to repay and they are more reliable customers. Lower risk score are people who don't try to take they are at a higher risk to pay more, as we know that most of these people might be in a financial obligations or more defaults come where they might have more huge debt to pay at a later stage. So this is the RLS security. And as conclusions, we can say that